Hi, I'm Rick Kahler, and thanks for joining me. Well, I've never seen more panic amongst investors. The continuation of the market crash seems to be causing even the most steadfast investor to consider cashing out of the market before they have nothing left. When our brains perceive that our survival is threatened, rational thinking just goes out the window. If you're feeling panicked and an urge to get out of the markets, first ask yourself the following question. If you cash out, what would you do with the money? Let's think about that. Let's say that you're retired or soon to be, and you have $1 million in a diversified portfolio with, say, 60% in stocks, REITs, commodities, things that you own, and 40% in bonds and cash, things that are loaned. Now, this portfolio over the last 10 years has generated a 7% return. And that's even after last year. But you've watched it go down 25% last year, another 10% this year, and you're getting scared. And you think that maybe you'd better preserve what you have before you have nothing left. So you need this money to generate you an income of $42,000 a year. What are your options? Well, the first thing that you could do is put that in cash, and by cash I mean a money market at a bank or a money market fund. But if we're on verge of catastrophe, as described by President Obama, is your bank really safe? Anything over $250,000 is not guaranteed, so you would need to put your money in 4 different banks to be totally safe. Of course, money market funds are not insured at all. So a better alternative to this would be to put your funds in a treasury bill, which is totally backed by the U.S. government. The problem is that both bank money markets, and T-bills are all paying about the same thing, which is 0.05%. And that's not 0.5%. That's 0.05%. And that generates only about $500 a year. So that leaves us a little short of our $42,000. So bank CDs, however, are a much better option. They're paying around 2% or $20,000 annually. But they don't give any protection against inflation. And again, they're at a bank, so you would need to split it up into 4 different banks. Well, a better option would be to go to Treasury Inflation Protected Securities. We call those TIPS. Now, these are 10 to 30-year bonds issued by the U.S. government, and they index the principal to inflation and pay 2% on top of that. Now, this is a far better alternative, especially if Uncle Sam cranks up the printing press in a few years in an attempt to monetize the staggering debt that we're incurring. This would net a person $20,000 a year, about $1,600 a month, which is still short of what's needed, but at least it's indexed to inflation. Well, are there any other options? Well, currently there's some really tempting bargains out there. AAA rated corporate bonds are yielding 5% or more, in some cases 7%, which in today's deflationary environment would completely meet your income needs, producing about $50,000 a year. High yield bonds would return even more, but have higher risk. The risk of bonds, however, is that the company may fail or inflation may erode the buying power in the future. So, are there other options? Well, certainly, rather than buy all bonds and to guard against inflation, you could add some real estate investment trusts. We call those REITs. Many of those are yielding 7 to 10% and would produce double the yield needed. So even with the coming decline in commercial real estate markets, and with REITs being beaten down by 70 to 80% off their highs, you could realize what you need for income, even if the dividends are cut in half. So these are very tempting, and they would tend to go up with inflation. You could also even add some dividend-paying stocks, which are yielding 3 to 5%. There are actually so many good options that the best option, rather than put all your eggs in one basket, would be to add a little bit of each one of these asset classes. Altogether, you'd have enough to provide for the income you needed with a little left over to increase the portfolio. But wait, that's exactly the type of portfolio that you already own, the one that you're trying to sell. It's really easy to panic if you focus on the devastating losses from the past 18 months. But instead, try focusing on your present condition and the options that you have today to generate income and recover what you've lost. Try looking at your current portfolio amount as if it were cash, and then ask yourself, if all I had today was cash, what would I do with it? Thanks for listening.